Let's assume that you start a business in bike rentals. You make an initial investment to buy a bike and then you start renting it to customers for rental income. So this business has cash outflows and then there would be cash inflows by way of income, right? Also, you can sell the bike at the end of say 5 years or so. So should you get into this kind of a business or not? The answer actually lies in net present value or NPV. NPV is one of the most important and powerful concepts in finance, and in this video we'll discuss all about NPV, what it means, its formulas, calculations and its uses. Hi all, my name is Dheeraj Vaidya from WallStreetMojo.com, the home to most authentic information on finance and accounting. Let's get started. So in order to understand the concept of net present value or NPV, we need to first master the concept of time value of money. Okay, so time value of money is divided into two parts. One is the future value of money and the other one is the present value of money. So let's understand both of them. The first is future value. Okay, so what do we mean by future value is, let's say you invest $100 today, and the rate of return that is expected is, let's say, 10%. So this is rate of return and this is your investment $100. Okay, so what will be its value, let's say, after year one? What will be its value after year one, right? So if you invest $100 today at a rate of 10%, the value will be 100 plus that 10% over 100, right? So by way of formula, the way we write this is equal to $100, that is D4 here, multiplied by bracket 1 plus 10. So essentially what we are doing is we are multiplying the original amount by that 1 plus 10%, that is 1.1. So that will be your future value. Okay, so that is at the end of year one. But let's say, what will be the value at the end of year two? Can we find that too? If assuming that the rate of return is again 10%, the straightforward formula is, okay, now that you have grown to 110, why not multiply this by another 10%? That is the rate of return. Okay, so that's what we get at the end of year two. Okay, so this is basically the concept of future value. So we keep on, increasing the value by the rate of return each year by multiplying it respectively. This year two formula can also be written in another format, and that's more important. It can be expressed as a part of the original investment multiplied by 1 plus your 10%, right? So the first part, this one will give you what will be the value at the end of first year, right? And then you increase it by another 10% by writing this formula again, 1 plus 10%, right? So what we are essentially doing is we are saying that this is the value after year one, and whatever is the value after year one, multiply again by this 1.1, that is 1 plus D5. Okay, so that is the value after year two. But instead of writing this like this in form of Excel, you can always use us to the power of 2, right? Because we are writing it twice. So instead you can use this to the power of 2. And we should essentially get the same answer. So this is $121 at the end of second year. How about third year? I guess this should be fairly simple, having learned how year one and year two behave. So the formula would be whatever the value at the end of year two, and then increase it by another 10%, right? And then we can again write that in the same format, like the way we were writing earlier, 1 plus 10% and to the power of 3, right? Because this is at the end of year 3. All right. So this is how the formulas will look like. So let me just display the formula for you. This is the first year's formula, right? The second year formula and the third year formula. So just note that, okay? This is first year and it looks exactly the same in the first year. To the power of 2 comes here and to the power of 3 comes here, right? So you keep on doing that for finding the future values. Okay, so now that you have understood the future value, let's now move on to the present value concept. So present value is nothing but the total opposite of future value. So in this case, what we are trying to understand is how much should we invest today, okay, in order to earn, say, $110 at the end of year 1. All right. So the question is clear, right? How much should I invest today so that I can earn $110 at the end of year 1, assuming that the rate of return is 10%. All right. Obviously, if you look at the previous problem which we did on future value, you pretty much know the answer, that the answer was $100 as the initial investment because it grew by 10% to give us 110, right? But how do we express this in the form of formula is the question right now. So let's do that. The formula is nothing but equal to, this is the desired amount at the end of first year, and you divide this by, okay, you divide this by 1 plus your 10%, okay? So in this case, you remember in future value, we multiplied the original investment by 1 plus the rate of return. In this case, it's exactly the opposite. We are dividing it by 1 plus 10% and we get the answer as $100. Okay. Now, let's take another step. Let's assume that you want to earn $121, okay, $121 at the end of second year. And you want to find out how much should be the present value today so that you can earn $121 at the end of second year, assuming that the rate of return is again 10%. So how does the formula change? The formula will be like this. You divide this value 121 divided by 1 plus 10%. And here you remember to the power of 2. Since this is at the end of 2 years, you need to divide this twice, right? So to the power of 2. So here you get $100 again. Now taking another step, year 3, if you wanted 133.10 at the end of third year, and you want to know how much is your present value today, then what will be your formula? The formula will be this divided by 1 plus your rate of return to the power of 3, right? So as you can see, to the power of 3 after 3 years, to the power of 3, when you're finding the present value, you're dividing by that, okay? So essentially, if you look at the formulas, let us look at the formula again, just for comparison. So in future value, we were multiplying it by 1 plus d5, 1 plus d5 to the power of 2 and 1 plus d5 to the power of 3. And for the present value, it's totally the opposite. We are dividing it by these numbers to the power of 2 to the power of 3, right? So this is how the future value and present value pan out, okay? Now that pretty much clear with these concepts, let us now go to the net present value. That should be fairly simple. Now, let us look at this example where we are expected to find the net present value of the project, okay? I understand we haven't learned yet how to calculate this NPV or the net present value, but this is the example and trust me, it is fairly simple. So let's go about understanding the project first and then we'll find the NPV or the net present value. This project is basically divided into 2 parts. One is you make your initial investment right now. That's how it is represented, year 0, that is $200 of initial investment. And once you make those investments, you're expected to get returns, right? So here we have this hypothetical returns at the end of year 1, $110, $120 at the end of year 2, and $130 at the end of year 3. And the discount rate or the expected rate of return is 10%, okay? So in order to find the net present value of a project, it is divided into 2 parts. The first step is to find the present value of all future cash flows, right? Second is to, understand what is your cash outflow that you are making today, okay? And the third is basically that you add this up, right? So net present value, whatever value you get, you deduct your cash outflow from today and you basically sum total both of them, okay? And that will give you your net present value, all right? But if you haven't understood these steps yet, let's do the calculations and you will fully get the idea, okay? So we'll do the first step first, okay? Net present value, or the present value of all future cash flows. So present value of year one cash flows, okay? PV is nothing but present value, okay? How do we find that? You remember that from the time value of money concept that we learned, this will be equal to 110 divided by 1 plus 10%, right? This is the present value of this year one cash flow, right? What about year two and what about year three? I think it should be fairly simple, right? Let's do that. Year two will be 120 divided by 1 plus 10% to the power of 2, right? And what about present value of year three cash flows? That will be 130 divided by 1 plus 10% to the power of 3. Okay. So this is the present value of year 1, year 2 and year 3. So what is the sum total of all this? This will be how much? Let's sum total this. This is 296.84. Okay. So this is the total present value which we have, right? Of the future cash flows. This is the first step which we did, right? Now, what's the second step? To identify what is the cash outflow. Cash outflow is how much? Minus $200, right? This is our cash outflow. So what will be our net present value? You basically do the sum total of these two. It's as simple as this. So the net present value will be the net amount of the present value. So what's your initial investment and what is the sum total of your present value which you are expecting, right? So net of that is nothing but the net present value. And here it is 96.84 in our case, okay? So this is how you basically find the net present value, all right? I hope you now understand conceptually how net present value can be calculated. But if you are interested in looking at the formula, we can also go through that. So here is the NPV formula or the net present value formula. And it is exactly the same as we discussed earlier. Though it might look a bit complex, it isn't. Okay, so NPV is equal to, and there are these things within the bracket. The first part is nothing but the present value of future cash flows. Okay, that was the first step, you remember? C1 is nothing but the first cash flow divided by 1 plus R to the power of 1 is R is nothing but the discount rate. Okay. Likewise, C2 divided by 1 plus R to the power of 2, and you do it until the end of the cash flow. So this first part is the present value of future cash flows which you're trying to find out. Now what is this X0? X0 is nothing but cash outflows. So the net present value will be the sum total of these two. So that's how we find the NPV. Okay. So NPV formula, fairly simple. You don't have to mug this up. You just need to remember that it is divided into two parts. First, find the present value of the future cash flows and then deduct it from the cash outflow and you will get the NPV. All right. So now that you know how to calculate the net present value of a project and you also understand the NPV formula, let's understand, how you can come up with these NPV calculations fairly quickly. Now, why I'm trying to emphasize on this problem is that, let's say in this case, you just had year 1, year 2 and year 3. But when you think about practical applications, you might not just have 3 years of data, you might want to project until 25 years from today. Now, would you like to kind of keep on calculating present value of year 1, year 2, year 3 to 25 years? Yes, you can do that. But I'm sure that will be fairly tedious, right? So in order to save our time, Excel has blessed us with a function called as the NPV function. What this does is it does step 1 in no time. So here we got this answer as 296.84 by doing these calculations, right? Let's apply this formula, which is function, from Excel. This is the NPV function, all right? And in this NPV function, you just have to give this rate. Rate is nothing but the discount rate, 10%, and value 1, value 2, value 3. So you can do that like 1 by 1, 110, 120, 130, so on and so forth. Or you can just select all of these at once, which I did in our case. And that's it. And press enter. So what do you get? This is a straight answer, 296.84. So this is my preferred way of doing it, because this makes all our calculations fairly simple and you're lesser prone to errors. In this case, you might just skip up to the power of 2 or maybe to the power of 3 in one of the cases. But here, nothing of that sort might happen. So at the end of the day, your value, net present value, will come out to be the same. So remember this NPV function that can be used as a power tool to calculate your NPV in no time. So the reason that we learn all about NPV, or the net present value, is at the end of the day, you should be able to understand whether you should accept the project or not, right? So here you will just follow a simple rule of thumb, and that is that if the NPV is, let's say, positive. Now, what does this NPV is positive means? It means that your present value of expected cash inflows is more than your cash outflows. In that case, your NPV will be positive, and that means you should accept the project. Okay. On the other hand, if it is negative, which means your present value of all your expected cash inflows, all right, that is less than your cash outflows, resulting in your negative NPV. This simply means that's a lose-lose situation. You shouldn't invest in the project and you should kind of decline the project. All right. So that's how this NPV basically works. Simple rule of thumb: positive, accept it; negative, decline it. All right. Now, another important thing to really look at here is the discount rate. Now, when you calculate NPV, you might have realized that the discount rate comes in the denominator, right? When we were calculating the present value, the discount rates come in the denominator. This essentially means that the NPV has an inverse relationship with discount rates, right? So if the discount rates are lower, the NPV will be higher. And if the discount rates are higher, the NPV will be lower. All right. So we'll just look at this example here, and we'll find out an intuitive way of understanding what we are essentially trying to grasp through inverse relationship of discount rate. But just intuitively understand here that discount rate is nothing but the rate of return which you are expecting from the project. And if you apply that rate of return and NPV is positive, that means, yes, you can expect the project to deliver positive cash flows and you need to accept the project. Okay. Now that's how it works. So let's find out this NPV of this cash flows which we have. Okay. So you remember this is the same example that we took. So 10% was the discount rate, and the cash outflows and the inflows are exactly the same from the previous example. So I'll calculate the NPV here. All right. So what is the formula? I'll use that NPV function in Excel, which we learned earlier. This is NPV. All right. Rate is 10%. And what are the cash flows? The cash flows are these, right? So if I close this bracket, this will give me the present value of all the future cash flows, right? Now, over and above that, I need to deduct my cash outflows, right? So how much will be my NPV? This is 96.84. Okay. So I just need to do these calculations for all the other discount rates, and I will get a graph here intuitively explaining how the relationship is. Now, let's do this for 0%. Okay. So if you are aware of Excel, you can actually freeze these cells using F4, and that will make our life very easy. You don't have to retype the calculations again and again. And if you still don't know about these relative references and absolute references, you can check out a blog or maybe refer to the videos which we have made earlier on this. But for the time being, I'll just keep these dollar signs here, assuming that you know about absolute references. And let's copy this formula here. So what we get is 160 is the net present value at 0% discount rates. Okay. And let's look at the others as well. Okay. So I'll keep on doing it. So what do we get? Now, as you might have expected, higher the discount rates, the net present value keeps on decreasing, right? As we assumed inverse relationship, and we saw that in the formula as well. Now, at NPV of, the discount rate of 10%, the NPV was 96.84. And at the discount rate of 100%, the NPV is 98.75%. So, when it comes to accepting the project, if your NPV is positive, you can accept the project, right? Accept here, 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 and maybe here as well. Now, what these changing discount rates mean is that, let's say if you were expecting a rate of return of 35% from your projects, then in this case, your NPV is very close to 0. All right. So still, you may want to accept it or reject it. It's a separate thing altogether. But here it is still positive, so I'm writing it as accept. But let's say if your expected returns were much, much higher, you wanted a 50% return on your investments, and this calculations gave you a negative NPV. So this would mean you need to decline the project, right? So in all the other cases, we just go ahead and decline the project. So that's how your NPV and discount rate relationships actually function. And you can see this in the graph as well. So by the way, the point at which, your NPV becomes 0, that's called as a internal rate of return. We will discuss this in a separate video in much, much more detail. But if you are curious to know, this is the point at around 35%. The internal rate of return of this project is 35%, and it is a point at which your NPV comes to 0. So finally, let us look at the limitations of NPV. Now, the limitations of NPV can be fairly understood with the help of the formula that we learned. So the formula had various inputs like the cash inflows, the cash outflows, and the discount rates, right? All basically we require these 3 inputs for calculating NPV. Now, if you look at all these 3 inputs, the only constant factor is that all of these are assumption-based or estimates. So what I mean by estimates or assumption-based is that, say for example, think of cash outflows. Okay. Now, here what you're trying to do is to estimate what your project might cost, correct? So you're estimating it. You really are not 100% sure that this is going to be the final amount, because you're estimating labor cost, machinery cost, etc. And you might have not, included some unintended expenses. So that is the estimate, assumption based. Likewise, when you think of cash inflows, you are talking about the revenues which you are going to earn after year 1, year 2, year 3, likewise. And your estimates might go wrong. Your assumptions could be from 30% to 50% to 100%. And maybe in year 1, you just did 10%. So again, you're just estimating it, assumption based. Likewise, the discount rates are also assumption based. And that's why it becomes a limitation in applying this net present value formula. Because, when you think of 2 analysts, the 2 analysts can have different set of assumptions and can lead to totally opposite results. One may accept the project on the basis of NPV, and one may reject the project on the basis of NPV. That can happen, and that's the limitation of NPV.
As we conclude today's discussion, a big thank you to everyone who tuned in from the Wall Street Mojo team. But hold on, the financial adventure continues. The next episode unfolds on Tuesday, and we're super excited about what's in store. Make sure to subscribe and turn on those notifications so you don't miss out on the financial insights coming your way. Until next time, this is the Wall Street Mojo team signing off. Stay informed, stay engaged, and stay Wall Street Mojo awesome.